On January 26, 2025, a trader in Shanghai looked at his computer screen and saw a number that should not exist. Silver was trading at $127 per ounce. In New York, at the exact same moment, the same metal was priced at $110. The gap between them was $17, and it was not closing. In 20 years of watching commodity markets, the analyst had never seen anything like this. A premium this large, holding this long, with no convergence in sight. He opened the COMEX vault reports and felt his pulse quicken. HSBC had withdrawn 615,000 ounces in a single day. Other depositories showed the same pattern. Metal flowing out, registered inventories declining, Chinese buyers paying premiums that violated every principle of market efficiency. And somewhere in New York, banks holding massive short positions were running the same calculation he was running. How much do we owe? How much is actually there? What happens when the vaults go empty? On January 26, 2025, a trader in Shanghai looked at his computer screen and saw something that should not exist. Silver was trading at $127 per ounce in his market. At the exact same moment in New York, the same metal was trading at $110 per ounce on the COMEX exchange. The difference was $17. $17 does not sound dramatic to someone unfamiliar with commodity markets, but to the analyst who understands how global markets function, that number represents a crack in the system, a crack that is widening. In normal market conditions, the price difference between Shanghai and New York silver ranges from 50 cents to $2 per ounce. Sometimes it reaches $3 during periods of high demand. The small premium covers the cost of shipping physical metal across the Pacific Ocean. It covers insurance. It covers the time it takes to move bars from American vaults to Chinese warehouses. This is standard business mathematics, but $17 is not standard. $17 is a statement. The trader in Shanghai made his decision quickly. He did not wait for COMEX prices to rise. He did not wait for Shanghai prices to fall. He paid $120 per ounce, and he did not hesitate. He needed the metal, and he needed it now. This moment reveals something critical about what is happening beneath the surface of global commodity markets. When a price gap this large appears between two markets that trade the same product, economic theory says the gap should disappear quickly. Here is how it should work. Traders see the $17 difference. They buy silver in New York at the cheaper price. They ship it to Shanghai. They sell it at the higher price. They collect the $17 profit. This is called arbitrage, and it is supposed to be automatic. The buying pressure in New York pushes prices up. The selling pressure in Shanghai pushes prices down. The gap closes. The markets converge. But the gap is not closing. Week after week, the premium holds. The arbitrage opportunity sits there, massive and obvious. Yet the convergence is not happening. The question becomes unavoidable. Why would professional traders leave $17 per ounce on the table? The answer has nothing to do with shipping logistics or insurance costs. The answer has everything to do with availability. The physical metal is not there. Or more precisely, the metal that exists in COMEX warehouses cannot be moved fast enough to satisfy what Chinese buyers are demanding. This creates a dangerous situation. Two markets that are supposed to be connected, that are supposed to move together, that are supposed to reflect the same underlying reality, are separating. The physical market in Shanghai is walking away from the paper market in New York. The distance between them is $17 wide and growing. For the business community, this divergence carries implications that extend far beyond silver. It signals that Chinese buyers have stopped trusting that COMEX pricing reflects physical reality. The futures contracts in New York can say silver is worth $110. It does not matter. When a Chinese manufacturer needs actual metal, real bars that can be shipped and melted and used in production, he must pay Shanghai prices. And Shanghai is saying $127. This is not financial theory. This is observable fact. The manufacturer running a solar panel production line does not care about paper contracts. He cares about keeping his assembly line running. He has delivery deadlines. He has contracts with customers. If his line stops because he lacks silver paste for photovoltaic cells, he loses money, far more money than $17 per ounce. So he pays the premium, every time, without argument. The $17 gap is not a temporary glitch in market efficiency. It is a signal that physical supply is becoming constrained while demand remains relentless. It is a warning that the world's largest consumer of industrial silver has decided that waiting for lower prices carries more risk than paying higher prices. And when the mathematics of arbitrage stop working, when the fundamental mechanisms of price discovery break down, the analyst must ask a harder question. What happens to the institutions on the other side of these contracts? What happens to the banks that sold silver they do not have? The vault data holds the answer. The spreadsheet looked ordinary. Just another daily vault report from the COMEX depositories. Rows of numbers, deposits, withdrawals, inventory adjustments. The kind of data that thousands of analysts scroll past without a second thought. But one analyst stopped scrolling. his eyes fixed on a single line in the HSBC depository section. In one day, 615,000 ounces of silver had vanished from the vault. Not over a week, not gradually, in 24 hours. He ran the calculation twice to make sure. 615,000 ounces equals roughly 19 metric tons of physical metal. Gone, moved out of the exchange system, no longer available to settle futures contracts. Then he looked at the other depositories. CNT had withdrawn 133,000 ounces. Brinks moved 156,000 ounces out. Delaware withdrew nearly 1,000 ounces. Even the smaller facilities showed negative flows. When he added it all together, the picture became clear. Metal was leaving the system fast. But here is where the story becomes more complex. Not all silver sitting in COMEX vaults serves the same purpose. The exchange divides inventory into two categories, and understanding this distinction is critical. The first category is called eligible silver. This metal meets all exchange standards. It is the right purity. It is stored in approved vaults. But it is not pledged to back any specific futures contract. Think of it as silver that is available but not committed. The second category is called registered silver. This is the metal that actually matters. This is the silver that backs futures contracts. This is what must be delivered when someone stands for delivery and demands physical metal. And registered inventories are shrinking. On that same day in January, HSBC did not just withdraw 615,000 ounces. They also reclassified 103,154 ounces out of the registered category. That metal had been available to settle contracts. Now it was not. The mechanics work like this. Each COMEX silver futures contract represents 5,000 ounces. Traders buy and sell these contracts constantly. Most never intend to take physical delivery. They are speculating on price movements. They settle in cash and move on. But some traders, particularly those in Asia, want the actual metal. They stand for delivery, and when they do, the exchange must produce it. The system depends on having enough registered silver to meet those delivery demands. So what happens when registered inventories decline while the number of outstanding contracts remains high? The mathematics become uncomfortable. The ratio between paper claims and physical metal starts to stretch. The institutions holding short positions begin to look at their exposure differently. Because a short position in silver is not just a bet that prices will fall, it is a potential obligation to deliver real metal. And if that metal is not in the vault when someone demands it, that becomes a serious problem. The analyst tracking these movements noticed something else. The pace was accelerating. He compared January 2025 to January 2024. The outflow rate had increased. He compared it to 6 months earlier, also higher. This was not random volatility, this was a trend. And trends in commodity markets rarely reverse without a catalyst. So where is this metal going? The answer is obvious when one looks at the $17 premium in Shanghai. Chinese buyers are signaling their willingness to pay significantly above COMEX prices to secure physical silver. When that kind of premium exists, arbitrage traders respond automatically. They buy metal from COMEX depositories, they ship it to Shanghai, they collect the premium. This is textbook commodity arbitrage. Except for one problem, the premium is not closing, which means one of two things. Either the metal is not flowing fast enough to meet Chinese demand, or the demand is so massive that even these enormous withdrawals cannot satisfy it. Either way, the conclusion is the same. Physical silver is becoming scarce in the exchange system. Not might become scarce, is becoming scarce, right now. And the banks holding short positions are watching these vault reports just like everyone else. They see the 615,000 ounces leaving HSBC. They see registered inventories declining. They see the Shanghai premium holding at $17, and they are doing the mathematics that every short seller must eventually face. How much metal do we owe? How much metal is actually available? What happens if we cannot deliver? Those questions do not have comfortable answers. Because in commodity markets, when the physical metal runs out, paper promises become irrelevant. In a manufacturing facility outside Shenzhen, a production line stopped. Not because of mechanical failure, not because of labor issues. It stopped because the warehouse had run out of silver paste. The paste is essential for photovoltaic cell production. Without it, solar panels cannot be manufactured. Without panels, contracts cannot be fulfilled. The plant manager made a phone call. 30 minutes later, he had secured a new shipment. The price was $127 per ounce. He knew that the same silver was trading at $110 in New York. He did not care. He approved the purchase immediately and the line resumed operation. This decision, repeated thousands of times across Chinese industrial facilities, explains something that traditional economic theory cannot. In textbooks, when prices rise, demand falls. Buyers wait. They negotiate. They look for alternatives. But in China's industrial sector, this is not happening. Factories are still buying. Importers are still booking shipments. Shanghai continues showing bids at $127, and nobody is stepping back. The reason is simple but profound. These buyers have made a calculation. They have decided that waiting is more expensive than paying the premium. Consider the mathematics from the plant manager's perspective. If his production line stops for 3 days while he waits for cheaper silver, he loses more than the $17 premium would have cost him. He has contracts with customers in Europe and North America. Those contracts include penalty clauses for late delivery. His assembly line employs 240 workers who must be paid whether the line runs or not. His overhead costs continue regardless of production volume. So $17 per ounce is not expensive. It is cheap compared to the alternative. He secures the metal. Production continues. Costs get passed downstream to the customer. This is rational behavior in a supply-constrained market. But the story extends far beyond individual factory managers making tactical decisions. Something larger is unfolding. The Chinese government has been systematically accumulating strategic commodities for years: copper, nickel, rare earth elements, gold, and now, increasingly, silver. The question is why? The answer reveals a shift in how China approaches resource security. Silver is not just an industrial metal, it is a strategic resource. Every 5G telecommunications tower uses silver. Every electric vehicle uses silver in its electrical systems. Every solar panel uses silver in its conductive pathways. Every advanced weapon system uses silver in its electronic components. Now they stockpile. Now they secure supply chains years in advance. Now they pay premiums when necessary, because paying premiums today is cheaper than facing shortages tomorrow. This is not speculation. This is state-level resource security planning, and it shows up clearly in the import data. Chinese customs reports show silver imports remaining elevated despite higher prices. Classical economic theory says this should not happen. Higher prices should reduce imports. But China's imports are not falling. They remain steady. Sometimes they increase. The demand is not discretionary. It is structural. It is built directly into China's economic development model. The silver is needed regardless of price. Whether silver costs $110s or $127s or $150, the factories must run. The solar panels must be produced. The vehicles must be manufactured. The infrastructure must be built. This creates a dynamic that Western commodity traders have rarely encountered. They are accustomed to price-sensitive buyers, buyers who negotiate, buyers who wait for better prices, buyers who can be pressured into accepting less favorable terms. But China is not that buyer. China has positioned itself as the price-insensitive buyer with effectively unlimited purchasing power. They have demonstrated they will pay whatever premium is necessary. They have shown they will not wait for Western markets to correct. They will not accept cash settlements when they demand physical delivery. This changes everything for anyone on the other side of the trade. In a normal negotiation, both parties can compromise. But in a market squeeze, compromise becomes impossible. The metal either exists or it does not. The delivery either happens or it does not. And when the buyer will not blink, when the buyer needs the commodity more than they need price stability, the seller loses control. The short seller becomes trapped. Not by manipulation, not by conspiracy, by simple arithmetic. They sold metal they do not have to a buyer who absolutely needs it and will not accept alternatives. The risk manager at a major bullion bank opened his morning report and felt something he had not experienced in 20 years of commodity trading. Not concern, not worry. Something closer to dread. His screen showed the bank's short position in silver futures. Thousands of contracts, each contract representing a promise to deliver 5,000 ounces of physical metal. He had run these positions for years without issue. Futures contracts almost never resulted in actual delivery. Traders settled in cash. They rolled positions forward. They closed out before expiration. The physical metal rarely changed hands. But this morning, his screen showed something different. Delivery notices. Chinese counterparties standing for delivery. Not one or two contracts. Dozens. And they were not accepting cash settlement. They wanted the metal. He opened the vault inventory report. Registered silver at COMEX depositories had declined again overnight. He did the calculation he had been avoiding for weeks. Total ounces the bank was short. Total ounces available in registered inventory. The ratio was moving in the wrong direction. This is the moment when theoretical risk becomes actual exposure. When spreadsheet models stop offering solutions. When the person running the numbers realizes they are not managing a position anymore. They are trapped in a situation they cannot control. Here is what a short position actually means in commodity markets. When a bank sells a silver futures contract, they make a promise. A legally binding promise to deliver physical metal at a specific price on a specific date. In normal market conditions, this promise never has to be kept. 98% of contracts settle without physical delivery. The system functions on the assumption that delivery remains the exception. But that assumption is breaking down. Chinese buyers are demanding the metal. The registered inventory that was supposed to cover those rare delivery demands is shrinking, and the banks holding concentrated short positions are facing mathematics they cannot manipulate. The problem is not distributed evenly across the market. A handful of institutions hold the majority of short positions: JP Morgan, HSBC, Scotia Bank, a few others. These names appear repeatedly in the commitment of traders' reports. These are the banks with the largest exposure. And they all operated under the same assumption: that physical delivery would remain marginal, that most contracts would settle in cash, that registered inventories would always be sufficient. Now they face a different reality. On January 26th alone, HSBC withdrew 615,000 ounces from COMEX vaults. CNT removed 133,000 ounces. Other depositories showed similar outflows. The metal is leaving the system while delivery demands are increasing. The squeeze is tightening. Some might argue that banks can simply buy metal on the open market to fulfill deliveries. Technically, they can, but at what price? If they start buying aggressively, they push prices higher. Higher prices make their short positions more expensive to cover. This triggers margin calls. Margin calls force more buying. It becomes a feedback loop, and in a tight physical market, the feedback loop can spiral beyond control. There is precedent for what happens when this dynamic reaches its breaking point. In March 2022, the London Metal Exchange faced a nickel crisis. A Chinese company held massive short positions. When nickel prices rallied, they could not deliver the physical metal. Prices spiked from $25,000 per ton to over $100,000 an hour. The exchange had to suspend trading. They retroactively canceled trades. They changed the rules mid-game to prevent complete systemic collapse. But there is a critical difference between the nickel crisis and what is unfolding in silver. In 2022, it was one company in trouble. In 2025, it is multiple major banks. In 2022, it was a speculative position gone wrong. In 2025, it is the world's second largest economy securing strategic resources. China is not manipulating the market. China is consuming silver. They are running factories, building infrastructure, manufacturing products. This is real demand, structural demand, and structural demand cannot be regulated away. Exchange officials cannot change rules to make Chinese solar panel factories stop needing silver. So the banks face three possible outcomes. None of them are comfortable. The first scenario is a soft landing. Prices rally sharply. The shorts take massive losses but manage to buy enough metal to cover their positions. The market stabilizes at a much higher price level. This is painful but survivable. The second scenario is a controlled crisis. One major institution cannot deliver. They default on contracts. Counterparty risk spreads. Other banks start questioning their own exposure. The exchange implements emergency measures, position limits, forced liquidation, mandated cash settlements. This happened with nickel. It can happen with silver. The third scenario is systemic failure. Multiple institutions cannot deliver simultaneously. Registered inventories drop below critical thresholds. Delivery failures cascade. The paper market loses credibility entirely. Physical silver decouples from futures pricing permanently. Nobody wants to discuss this scenario, but it is mathematically possible. And the data suggests the market is moving closer to it, not further away. Shanghai continues trading at $127. New York remains at $110. The vaults are emptying. And in trading rooms across New York and London, risk managers are looking at the same screens, running the same calculations, reaching the same conclusion. They cannot deliver metal that does not exist. And when delivery fails, everyone watching commodity markets will learn what the nickel crisis already taught. Paper promises are only worth what they can physically deliver. The countdown has begun.